Watchers have all been upping their forecasts for rate hikes, in some cases to 7 this year. Yesterday, the Fed's Esther George said cutting the balance sheet more quickly would lessen the need for so many rate hikes. So what should the Fed do here? Just in time, we have the results of a new flash Fed survey looking at this very issue. Steve Leisman is here with those results. Steve?
Yeah, you got questions, Kelly. We got answers. The CNBC Flash Fed Survey. We did this after the Fed meeting to see if the outlook changed from the prior survey. It finds our respondents not quite as hawkish on rates as pricing in the Fed's funds futures market for those 5 rate hikes that are there now. Among the 38 respondents, the average looks for 3.7 hikes this year. How do you read that? It really means 3 hikes are built in, and there's a debate with a leaning towards a 4th hike. The average fund rate is seen at just over 1% by the end of the year. Next year, another 3 hikes are forecast, with the funds rate rising to 1.8%. Only one respondent sees 5 hikes, and there is little support at all for a 50 basis point rate hike, at least in March. The outlook for inflation, now running at 7% year over year, is for a decline down to 4.2%. and a 2.9 by the end of 2023. So maybe this more dovish outlook on rates comes with a belief that inflation will indeed come down and what the Fed does will work. Another reason, respondents are looking for more balance sheet runoff than the prior survey, a la Esther George. As Kelly said, the average looks for the balance sheet to begin running off in July and the total $460 billion this year, and that is up from the prior forecast of $380 billion. That grows to $930 billion next year, up from $860, and $2.5 trillion over 2 years and 8 months of runoff. That is less overall than the prior survey. So the course of inflation, it's going to ultimately determine how much the Fed does. And guess what? The course of inflation will, of course, be influenced by Fed policy. Kelly?
Certainly will. Steve, stay right there. My next guest is more in favor of using the balance sheet than rate hikes, saying that will do more to reduce excess liquidity. Joining us now is Bill Lee, Milken Institute's chief economist. Bill, welcome. Tell me why you prefer balance sheet and what exactly you'd like to see.
Well, everyone got on the rate increase bandwagon when Chair Powell said the labor market is very strong. But what we see from the latest GDP numbers is that the economy itself is starting to slow down off of the peak growth of the post-COVID recovery. But the excesses from the Fed easing of conditions is still showing up in the housing market and asset markets. So the easiest way to sop up that excess liquidity that's causing these difficulties is to use the balance sheet. And the rate increases will be governed, as Chair Powell said, strictly by what's going on in the real economy. And I think people are underestimating the degree to which the U.S. economy is slowing down. Final sales only grew by 2% last quarter, and most of that growth came from inventories, which was a desired increase in inventories, but some of the inventories are undesired.
Well, let me stick with what you're saying, Bill, which is that if you want to remove the excesses in places like the housing market without slowing the economy, you'd rather see them run down the balance sheet, which would mean ultimately, sales of these treasuries. But wouldn't that itself also push up rates? It's arguable that that would push up long rates more than if they raise rates on the short end, which so far has been flattening the curve.
Well, it's actually very controversial, the degree to which the balance sheet itself transmits to the rest of the economy. It's very clear that the balance sheet affects liquidity, and the sectors that are sensitive to liquidity in the financial markets are affected, but it's not across the board kind of dampening of demand that you get with interest rates. So I think the whole policy of trying to be strategic and targeted in how the Fed responds is very critical here. And I think the problem of going overboard, which has been the problem of every Fed policy move in the past, where they've gone too much, too far, too fast with interest rates, we now have a second tool where we can get rid of specific excesses with the balance sheet. And Esther George is absolutely right. She's the most hawkish of the committee, and she is even preferring balance sheet over rates. That's amazing.
Yeah, that's what made it so eye-catching yesterday, Steve. So if this were the case, let's maybe first ask if you think it will be the case, because we haven't heard as much talk about, the balance sheet. We've heard even from the Atlanta Fed's Raphael Bostic. He said, I would support a 50-point hike if we needed one, if conditions changed that way. But he wasn't necessarily saying, then I'd immediately want to see a faster rundown of the balance sheet.
So this goes back to the group of Midwestern hawks that we've been talking about, Kelly. It began with Jim Bullard, and then Governor Waller also has talked about this. He's also from St. Louis, Kansas City. I think you can put in the Midwest, and we have yet to hear necessarily from Esther George about this. There is a contingent on the committee, for sure, who wants to use the balance sheet, sell more on the long end, put pressure there, let rates rise there, and perhaps do fewer rate hikes on the short end, and also be careful not to be flattening the curve. That said, after Esther George said that again yesterday, I went back and looked how Chair Powell responded to that. And all I can say is he seems to be agnostic over the issue. At the time he spoke, the spread between the 210 was 75 basis points. He seemed to be rather happy with that. It's since fallen to around, 60 and change or so. So he didn't have to deal with it. I don't know that that's his preference. It was not the impression I got from listening to it. I think, though, and I think maybe Bill would answer this better than I don't think the Fed wants to get involved in yield curve engineering because it's just a matter of massive uncertainty for the Fed.
Shepard Smith here. Thanks for watching CNBC on YouTube.